Hey traders, welcome back to our YouTube channel. In today's video, I'm going to teach you about the 3 crucial phases of the market. Understanding these phases is essential for making smart trading decisions and maximizing your profits. Whether you're a beginner or an experienced trader, this knowledge will help you navigate the markets more effectively. Let's dive in. Here are the 3 phases of the market that you should know and understand. In phase 1, we have an impulsive movement to the upside, breaking above the previous high. This indicates that the overall market sentiment is bullish. When we see the market pushing up strongly, it's a clear sign that buyers are in control and driving prices higher. However, this bullish momentum can't last forever. Eventually, the market reaches a point of exhaustion, where the buying pressure starts to wane. This brings us to phase 2, the pullback phase. In phase 2, the market will temporarily drop to the downside to regain its bullish strength and fill any gaps it left below. This pullback is a natural and healthy part of the market cycle, as it allows the market to breathe and gather more momentum for the next move up. The market will typically drop until it retests a higher timeframe point of interest. This phase can often present good buying opportunities for traders who are patient and know what to look for. The last phase is known as the continuation phase. After finding demand and regaining strength, the market will respect the point of interest and impulsively push to the upside once again, breaking above the previous high. This phase confirms that the bullish trend is still intact and can often lead to significant gains if you're positioned correctly. These are the 3 phases of the market: the impulsive movement, the pullback, and the continuation. Understanding these phases to the core can help you make more informed trading decisions and maximize your profits. Let's take a look at some actual chart examples to illustrate these phases in action. In this uptrend, we start with the initiation phase, which is the impulsive movement to the upside, breaking above the previous high. This phase indicates strong bullish momentum as buyers drive the market higher. The market continues to push up until it reaches a point of exhaustion. At this point, the bullish momentum slows down, leading to the pullback phase. During the pullback phase, the market temporarily drops to fill all the gaps it left below and regains its bullish strength. After this retracement, the market enters the continuation phase, where it impulsively pushes to the upside again. This confirms that the overall upward trend is still intact. In this downtrend, we begin with the initiation phase, where the market impulsively pushes to the downside, breaking below the previous low. This phase shows strong bearish momentum as sellers dominate the market. The market continues to drop until it reaches a point of exhaustion. Here, the bearish momentum slows, leading to the pullback phase. During this phase, the market temporarily moves up to fill all the gaps it left behind and regains its bearish strength. After this correction, the market enters the continuation phase, where it impulsively pushes to the downside again. This confirms that the overall bearish trend is still intact. Most traders are familiar with this basic anatomy of the market but often don't know how to effectively capitalize on these phases. That's exactly what I'm going to teach you in this video. What I'm about to share with you is very important, so stay until the end and make sure you understand the concepts. When you analyze the charts, it's important to always start with the higher time frame. The higher time frame forms a template on which you should base your trading decisions. In this time frame, you should focus on 2 main things. First, determine the directional bias of the market. In this example, we had a break below the previous low, indicating that we are in a downtrend and should look for long-term selling opportunities. Second, mark the key higher timeframe demand or supply zones. In our downtrend example, we will mark our supply zones. Here, we have 2 valid supply zones. However, the first one acts as an inducement. I won't explain this concept in detail in this video, but I'll leave a link in the description to a video that covers inducements in depth. Now that we understand the 3 phases of the market, we know that this initial phase is the initiation phase, characterized by an impulsive movement to the downside breaking below the previous low. The price will push down until it loses momentum and reaches a phase of exhaustion. This is followed by the pullback phase, where the market will most likely retrace back to retest our key higher timeframe supply zone, and finally, the continuation phase. Since we know this anatomy, if we can correctly identify the point of market exhaustion, we can capitalize on short-term buy opportunities during the pullback phase. Then, we can capitalize on long-term sell opportunities during the continuation phase. So, how can we accurately identify the point of market exhaustion? The best sign of market exhaustion is a change in market character in the smaller time frame. Let's transition to a lower time frame to look for a change in market character within the lower time frame structure. On this time frame, we wait for the market to break above this local swing high. Once that happens, it indicates the start of the pullback, meaning we can now start looking for short-term buying opportunities. You can now mark your demand zone and wait for the price to pull back and retest it. Execute your buy orders, and your take profit should always be just above the local swing high in the pullback phase. As you can see, the market respected our setup and hit our take profit. We had another break of structure, signifying that the pullback phase is still ongoing. So, mark your demand zone and wait for the market to pull back and retest your demand zone. Execute your buy orders and remember to place your take profit just above the local swing high in the pullback phase. Again, the market respected our setup and hit our take profit. Before we continue, there's a very important thing you have to note. Once the pullback phase reaches the 50% level of the Fibonacci retracement, we stop looking for buying opportunities. That is because above the 50% is the premium range where a lot of traders will be looking for selling opportunities. So, in everything we do, we have to try not to go against the market momentum. All we can do now is hope that the price will push up and retest our supply zone so that we can get our long-awaited selling opportunity. Once that happens, execute your sell order and the price will most likely respect that setup. By understanding the three phases of the market, we were able to get profitable trading opportunities in the pullback phase and also managed to get the long-term selling opportunity in the continuation phase. Let's do the very same steps on this price chart example. First, we had a break above the previous high, which implies that the directional bias of the market is bullish, meaning we should be looking for long-term buying opportunities. We then identify key higher timeframe demand zones for possible buying opportunities. Now that we know the three market phases, we understand that this is the initiation phase. The market will keep pushing up until it reaches a point of market exhaustion. Eventually, the market will pull back to fill the gaps it left below and regain its strength to continue pushing to the upside. What we have to do now is accurately pinpoint the point of market exhaustion so we can get selling opportunities in this pullback and then catch the long-term buy position in the continuation phase. To catch the start of the pullback, we have to transition to the lower time frame and wait for a change in market character within the lower time frame structure. On this lower time frame, we wait for the price to break below this local swing low. Once that happens, it means that this is the point of market exhaustion, indicating the start of the pullback. From here, we can start looking for our short-term selling opportunities. Identify your supply zone and wait for the market to retrace and retest it. From there, execute your sell orders and always remember to place your take profit just below the local swing low during the pullback phase. The market will most likely push down and hit your target. Before we continue looking for further selling opportunities, I have to remind you of something very important. Always remember that once the price reaches the 50% retracement level, you should stop looking for any further selling opportunities. That is because below the 50% level is the discount price range where most traders will be looking for buying opportunities, so selling within this zone is considered unwise. All we can do now is hope that the price will push down and retest our demand zone. Once that happens, we can execute our long-term buy orders, and the market will most likely shoot up, putting you in deep profits. I hope that with the example we covered so far, you can notice that understanding the three phases of the market is crucial and can help you make more informed trading decisions. Let's look at the last price chart example and apply the very same steps. Always remember to start analyzing on the higher time frame. In this time frame, we had a break above the previous high, indicating that the overall market sentiment is bullish, meaning we should be looking for long-term buying opportunities. Secondly, we identify key higher time frame demand zones for possible buying opportunities. Let's apply the three phases of the market. We know that this is the initiation phase. The market will push up until it loses momentum, which is referred to as market exhaustion. After the loss of momentum, the market will pull back to fill the gaps it left below and regain strength to continue pushing to the upside. Now let's try to accurately pinpoint the point of market exhaustion to get selling opportunities during the pullback phase and catch the long-term buying opportunity during the continuation phase. To identify the point of market exhaustion, we have to transition to the lower time frame and wait for a change in market character within the lower time frame structure. On this time frame, we wait for the price to break below the local swing low. Once that happens, it indicates the start of the pullback phase, meaning we can start looking for our short-term selling opportunities. Identify your supply zone and wait for the price to retest it. Execute your sell orders, and the price will most likely drop and hit your target. We had another break below the previous local swing low. Identify your supply zone and wait for the price to pull back and retest it. Execute your sell orders, and the price will most likely drop and hit your target once again. Before you continue looking for selling opportunities, you must remember this crucial rule: once the price retests the 50% retracement level, you should stop looking for further selling opportunities, because below the 50% level is the discount price range where a lot of traders will be looking for buying opportunities. Wait for the price to drop and hopefully reach your higher timeframe demand zone. Once that happens, execute your long-term buy orders, and the price will most likely push up and hit your target. In conclusion, by understanding and applying the 3 phases of the market, you can make more informed trading decisions. This approach allows you to capitalize on both short-term and long-term opportunities, maximizing your potential profits and improving your overall trading strategy. Make sure you take your time and learn the concepts covered here, never taking them for granted. One thing I like most about understanding the 3 phases of the market is that it can help you avoid unnecessary losses. One common mistake most beginner traders make is approaching a pair like this one. Here, we have a beautiful downtrend that seems to respect price action. We had a recent break of the previous low, indicating that the downtrend is still intact. You then identify your supply zone and wait for the price to pull back and retest it. From here, you execute your sell orders with take profit just below the previous low. However, the market pierces through your supply zone, completely violating your setup and taking you out. You are left wondering what went wrong because your setup seemed perfect. Let me tell you this, and always keep it in your mind: no matter how beautiful and promising your setup is, if you are going against the overall market momentum, you are destined to fail. That's why it's always important to start on the higher time frame and break it down to the lowest. When you start analyzing from the higher time frame, you can see that this is just an internal structure of the overall higher time frame structure. We had a break below the previous swing low, indicating that we are in a downtrend. However, the market is in the initiation phase and will keep pushing to the downside until it reaches a point of market exhaustion. With the bearish momentum slowing down, you can now see that selling from this point was an unwise decision because there is not enough momentum to keep pushing the market to the downside. What you have to do here is transition to the lower time frame and wait for the market to break above this local swing high. This indicates that we are now in the pullback phase and can start looking for buying opportunities. Identify your demand zone and wait for the market to retest it. Execute your buy orders, and the market will most likely respect your setup. Always remember that once the price retests the 50% retracement level, we stop looking for buying opportunities because, at the premium price, the market will regain its bearish momentum. So, always align your trades with the direction of the market momentum. From here, all we can do is wait for the price to push up and reach our supply zone. Execute your sell orders, and the price will most likely push down and reach your target. That's it for today's video. I hope you found this information valuable and that it helps you make more informed trading decisions. If you enjoyed this content and want to see more, please don't forget to like this video and subscribe to my channel. Thanks for watching, and I'll see you in the next video.